Happy New Year and welcome to the weekly macro roundup for 3rd January 2026, presented by Michael Ogunremi. In the United States, Trump announced his intention for Fed chair pick in January. Global equity desks cited rising unemployment, sticky inflation, trade wars, the affordability crisis, fears about Fed independence, misleading government data, and an AI bubble notwithstanding as top downside risks to the equity market in 2026. On the bond space, the outlook for the new year is rather cautious, with some market watchers forecasting slower returns as the Federal Reserve dials back rate cuts and potential fiscal stimulus. Relatedly, the volatility index for the U.S. Treasury bonds headed for its biggest annual drop since 2009. Proposed tax cuts in the One Big Beautiful Bill are expected to stoke growth in 2026. But the dissenting views of Fed members suggest that the impact could be well offset by downside risks. Traders' forecasts for 2 rate cuts next year remained unchanged. In China, Beijing will lower import tariffs on key components and advanced materials next year, as President Xi Jinping declared China is set to meet its economic targets for 2025, with growth expected to reach about 5%. 2 main data releases were factory activity for December, which indicated an expansion, snapping an 8-month contraction streak that was the longest slump on record, and profits at Chinese industrial enterprises, which fell 13.1% year-on-year in November. Policy in 2026 will focus on investment for priority sectors such as advanced manufacturing, tech innovation, and the development of human capital. China announced initial public spending plans worth a total of $51 billion to boost consumption and investment next year. In the Eurozone, the spat with the U.S. over digital service trade emerged, fostering a split between having a trade deal on manufacturing and a trade conflict on services. The manufacturing sector continued to decline for the 2nd consecutive month, with drags from Germany, Spain, and Italy. Growth is expected to be subdued in 2026 as EU-China bulging trade deficits weigh on trade balance. This week, Bulgaria finally joined the bloc, adopting the euro, a positive development for the nation. Moving on, the United Kingdom, the economy is set for a modest rebound in economic growth, while inflation is likely to simmer down to the Bank of England's 2% target by the end of 2026, according to Bloomberg. This coincided with manufacturing PMI printing in the expansion zone for December. The FTSE 100 crossed the 1,000 mark, a laudable development since the 2008-09 global financial crisis. On data release, UK consumers cut card spending by 0.2% in 2025, the first drop since 2020, while UK house prices fell in December for the first time in 4 months. With rising taxes through 2025, Keir Starmer's approval rating plummeted to -66 in 2025, as he promised that the UK would turn a corner this year. In Canada, the boycott of everything American continues following the ongoing trade war, which keeps impacting growth negatively. Bloomberg's survey suggests growth will improve to a 1.9% pace by the 3rd quarter. Inflation will stay subdued, and the unemployment rate will fall. However, this outlook depends on the effective implementation of Carney's enormous budget read in November 2025. The Japanese yen failure to capitalize on the weak USD in 2025 led to the call this week to the government to address the yen's weakness, which is inflating import costs and weighing on households and businesses. Some members of the Bank of Japan's board signaled in a meeting this month that the country's real interest rate remains very low, suggesting that further increases are likely in store. Japan plans to ramp up defense spending in 2026 in the wake of tensions with China. Thanks for watching. If you like this content, please subscribe, like, and click on the notification button on this channel. See you next week.